US dollar 5% bond at a discount of $5,000. Vera PLC incurred transaction cost of $2,000. Interest is received annually in arrears. This will be redeemed at a premium of $5,960 over nominal value on 1st January 2014. The effective interest rate is 8%. The fair value of the bond was as follows. Assume all figures are correct. Required. Explain how the bond will have been accounted for over all relevant years. If A, Vera PLC business model is to hold bonds until redemption date. B, Vera PLC's business model is to hold bonds until redemption date but also sell them if investments with higher returns become available. C, Vera PLC business model is to trade bonds in the short term. Thank you. I'm through reading, sir.
Okay. Are you done reading? Are you done reading?
Yes, sir.
All right. Thanks. Thanks. Sorry, 1 minute. So if you look at that question, we have okay, good. Yeah, so that question, the entity purchased the bond, so automatically is a financial asset to the entity. And they now ask us to explain how they will account for it. If their business model is to hold the bond until redemption day. Their business model is to hold the bond until redemption date. Their business model is to hold the bond until redemption date. Then that means they are holding it to collect it. And in that case, since what they will get from this bond is only the principal and the interest, since what they will get from this bond is only the principal and the interest, then we have to account for it using what? We have to account for it using amortized cost. Then using amortized cost to account for it, have what? We have Vieira A, where business model is to hold bonds until redemption date will have what? I, the initial measurement will be what? Initial measurement. Initial measurement will be okay. So the initial measurement would be nominal value of the bond $100,000. Discount 5% of $100,000. That will be 5,000. Discount will be used to reduce the cost. Then transaction cost. We have said that transaction cost should be added. So we had transaction cost of 2,000, and that will make how much? 97,000. Having done that, we can now prepare our amortization schedule. Our amortization schedule will be a year, opening balance, the interest at the effective interest rate, which is 8%, the payment at the nominal interest rate, which is
5%.
nominal interest rate is what?
5%.
Okay, the 5% here is actually the interest rate. The discount, they gave us the discount outrightly to be to 5,000. So
5,000.
let us take this one and say the discount is 5% of 100,000. So if that is the case, payment is at
5%.
5%. Then closing inventory, closing balance. So for year 2011, the opening balance is 97,000. Interest at 8% will be how much?
That's 7,760.
7,000.
760. Can you hear me?
Yes, 7,000.
7,760. 7760.
760.
Yes, sir.
Okay, so the payment 5% of 100,000 would have been 5,000. So what do we have as the closing balance? What do we have?
99,760.
99,760.
760.
So in 2012, we'll have 99,760. And 8% of that will be what?
7,760. 98981. 981.
981.
Yes, sir.
Okay, if we pay 5,000, what will be the closing balance?
That's 1027741. 1027.
12741. If it is 102,741, 8% interest on that will be how much?
8,219.
8,219.
219.
So what do we have as the balance?
That's 105959.
105,959.
959. Yes.
Are you sure?
Later, if you just approximate to the 105960. I think it should be,
Also 105,960.
yeah, it's approximation. It's correct. So that 5960 is the premium.
So ṣẹlẹ̀ now. Ẹ pé èèyàn ń pọ̀ tẹ́lẹ̀ ń pè. Bí kí ni
Sorry.
105,960. Okay, so that explains why they said we are redeeming at a premium of 5,960. As you can see, the 100,000 now will be paying them excess of what? 1,051. We'll be paying them an excess of 5,960. And that excess is more or less like the interest we did not pay over the 3 years plus interest on it also. No, we are supposed to be paying interest at 8%. We were paying at 5%. So that 3% difference that we are not paying is what we have.
Okay. So is the difference between the effective rate and that coupon rate that makes the premium, right?
Is most likely what will make the premium. Because there's actually nothing free, even in Twitter. So if you are not paying the interest immediately, you later pay them at the end of the contract.
Okay.
Yeah.
Perfect.
So that is that. So having done this, our SOPL extract will then be what? SOPL extract would be how come you are not in church?
Good morning, sir.
Good morning. How come you are not in church? That's the question.
Because I'm in class now.
No, don't go and tell that to God on judgment day. I know who you. Income. Our finance income will be what? Our finance income would be
97,000.
2011, it will be 7,760. 2012, it will be 7,981. Then 2013, it will be 8,219. And after that, in our statement of financial position extract, we then have what? Non-current assets, financial assets. Then current assets, financial assets. So initially it will be a non-current asset at the end of 2011, 99,760. At the end of 2012, 102,741. By the end of 2013, when it now becomes due to be settled within 12 months, it becomes a current asset, which will be 105,960. So that when they now receive the redemption value, they will just debit their bank and credit this liability account. Is it clear?
Yes, sir.
All right. Okay. So having done that, we are done with the first aspect, which asks us to show how the bond will be accounted for if they are holding the bond until redemption date. Number B part, they ask us to show how the bond will be accounted for if their business model is to hold the bond until the redemption date, but they can also sell them if investment with higher returns becomes available. That means they are unsure, they are doing like some ladies, they don't know what they actually want in life. So they follow anything they see. So if that is the case, we saw this is where you are holding to collect or sell. And when you are holding to collect or sell, we do what? We fair value through other comprehensive income. Where business model is to hold bonds on redemption, but also sell if investments with higher returns becomes available. So what do we have? If this is the case, our initial investment, our initial measurement will still remain the same because we are fair valuing through OCI here, and we'll see capitalize transaction cost, and we'll have what? Nominal value of the investment, 100,000 less the discount, 5,000. We had what? Transaction cost. How much is our transaction cost? 2,000. So the value will still be 97,000. Then, because we are holding to collect, we'll have to prepare an amortization schedule. So in our amortization schedule, we'll have what? The year, opening balance, interest at 8%, payment at 5%, then closing balance. So for year 2011, we'll start with 97,000. Interest will still be 7,760. We have paid 5,000. And the total will be 99,760. Abi? This is what it would have been if they only want to hold to collect. But because they can also sell, it triggers us to calculate fair value difference. Because we understand that they can also sell also. Fair value difference. So the fair value difference will have for 2011 will be fair value at the end of the year. Fair value at the end of 2011 is what? 98,300. Less carrying amount. What is the carrying amount? 99,760. So with that, it shows we have a loss of how much? 1,460. Fair value loss. Does it make sense?
Yes, sir.
Okay. So for year 2012, we start the year with what is now the closing balance. It is the fair value, Abi, because we fair value the 98,300. Interest at 8% will be what? Interest at 8% will be what?
7,864.
7,864.
864. Yes, sir.
So if they pay 5,000, the carrying amount will be how much? Figure.
That's 101,164.
101.
164.
164. So because they can still sell also, we calculate the fair value difference. Fair value carried down is how much? At the end of year 2012, fair value is 107,500 with less carrying amounts. Carrying amount, which is 101,164. So with that, fair value gain is how much?
6336.
6336. That's our fair value gain. Then 2013, we start the year with what? 107,500 because that's the fair value now. Interest at 8% will be what? Interest at 8% will be what?
8600.
8600. And if we pay 5,000, the closing balance will be what?
That's 111,100.
111,100. So for 2013, this place will not contain it. Before you say I'm spoiling your eyes. Because humans, you don't appreciate my effort in making the world a better place. So the fair value is what? At the end of year 3, 115,000 with less carrying amount, which is what?
111,100.
100. And with that, we have fair value gain of how much?
3,900.
3,900. So SOPL extract will have what? For our income, the income we have is finance income. Our finance income will be in 2011, 7,760. 2012, 7,864. 2013, 8,600. But it doesn't end there. We have other comprehensive income, fair value gain or loss. fair value gain or loss. In 2011, we have a loss of 1,460. Then in 2012, we have what?
A gain of 6336.
You know that gain now is the closing balance of what we had. Abi? So in
Yes.
order to know what will be what will go to our SOPL, let's assume this is the OCI account. You know, in 2011, as we have what? As we have this fair value loss, it means we are reducing our asset. We would have credited our asset and debited this entry here.
Okay.
Financial assets. Abi? Let me draw it properly so that you can get a feel of what I'm doing. Okay. We have fair value gain or loss. The one that will go to our other components of equity. So during the first year, 2011, we made a loss. The loss would have been used to reduce our assets. We would have credited our assets to reduce it. Abi? The corresponding debit entry will be here. Financial assets, 1,460. In the absence of any other information, we'll have the balance carried down, 1,460. 2011 is done. Abi?
Yes, sir.
In 2012 now, we would have had the balance brought forward on this side, 1,460. And when we now have a fair value gain of 6336, we want to increase our asset by 6336. We would have debited financial asset. The corresponding credit entry will come here, financial asset. How much? 6336. Abi?
Yes, sir.
So the balancing figure, which will be our OCI, will now give us how much?
That'll be 4876.
4876. So we'll have 6336. So that means in the following year, so this figure now is what will be our balancing figure, balance carried down. So this one that we have as financial asset now is what we'll take to our OCI.
Okay.
That's how much? 6336. Then in the next year, the balance works forward will be here, 4876. And we now have another financial asset of how much? 3009. We bring it here again. Financial assets, 3,900. So the total will be what? And the balance carried down will be what? 8,777. I mean,
Yes, 8776.
so here we'll still have what? 3,900. 3,900. So last statement of financial position extract. Okay, sorry, we've I think we've mixed it up. This should have been our OCI. This one we have here, the difference we have here, because the
But
OCI should have been debited to the financial asset account and be credited to what? To the other comprehensive income, being the gain we made during the year. Because if we have it on the credit side here, it means we are debiting it, and debit means is an expense, of which is not the case. So our OCI should have been 4876.
okay.
So if that is the case, this now represents our closing balance. Our closing balance. So if this is our closing balance, for 1 minute, I'm sorry, my internet was interrupted. Yeah, can you hear me? Can you hear me?
Yeah, sure, I hear you.
Okay, so the
Yes,
financial
sir.
asset at the end of 2011 will now be the fair value, which is 98,300. At the end of 2012, it will be what? 107,500. And at the end of 2013, when it becomes, it will now be 115,000. Then under our equity, we will have what? Other components of equity. Other components of equity, we have fair value gain or loss. Fair value gain or loss. And in the first year, we have a fair value loss of 1,460. That's why we are having a debit balance. Then the next one, we are now having the credit balance of what? Of 4,876. And the third one, we are having a credit balance of what? 8,776. So that is that on if the bond is to be held until redemption, but also can be sold if there is investment with higher returns. The last one is if the business model is to trade the bonds in the short term. Trade the bonds in the short term. C. Business model is to trade bond
In the short term.
in the
That's fair,
short
fair
term.
value.
That means we'll be fair valuing to a statement of profit or loss. So in that case, our initial investment will be different from the ones we've done before. Our initial investment would be the nominal value. The nominal value, which is what? 100,000
1,000 minus discount minus transaction
the less discount of how much? 5,000.
5,000.
But we cannot add transaction cost here because transaction cost will be expensed in the statement of profit or loss. Are we getting it?
Okay.
Transaction cost will be expensed in the statement of profit or loss. So then do what? For each of the year, we'll be calculating fair value difference. For each of the year, we'll be calculating what? Fair value difference. Fair value difference. So we'll say fair value difference in 2011, the fair value at the end of the year is how much? 98,300. Abi?
Yes,
We
sir.
less the carrying amount of the bond, and the carrying amount is what?
95,000.
Sorry, 98,300 is the fair value, but the carrying amount is 95,000. So that means we'll have a fair value gain of how much?
3,300.
Of 3,300.
3,000.
In 2012, our fair value at the end of the year would be what? 107,500. But less the carrying amount for that year. Carrying amount will be the fair value at the end of last year, which is 98,300. So with this, the fair value gain is how much?
9,200.
9,200. Then the third year, the fair value at the end of the year is how much? 115,000, with less the carrying amount at the beginning of the year, and that is what? 107,500. And that will give us how much?
7,500.
7,500. So if that is the case, we can then go ahead to what? And then go ahead to prepare our SOPL extract. So our SOPL extract at the end of each year would be what's the name? Our income would be fair value gain, which is 3,300 in the first year, 9,200 in the second year, then 7,500 in the third year. Then we'll have expenses. Abi, what is our expenses? Our expenses will be the transaction cost. The transaction cost. How much? 2,000 in year one only. We don't have any other expense. Then in our statement of financial position extract, we'll have what? 2011, 2012, and 2013. Current assets, financial assets. Because when we are holding it to sell it, we just take it as fair for current asset because we can sell it at any point in time. So in 2011, it should be what? $98,300. 2012 it was 107,500, and 2013
Okay.
any question at this point?
I can't hear you. I don't hear you at all. The network is terrible.
Hello, can you guys hear me now?
Yes, sir.
Yes, sir.
Someone should read question 10. Or do we have any question on the previous topic we did? On the previous question we did. Oh yeah, oh.
Question 10. Require. Show the financial statement extracts for the period to 31st March 2017. On 1st April 2015, Bale PLC issued a financial liability value for its nominal value of $25 million. Interest is payable at a rate of 8% in arrears, while the effective rate is 10%. The liability, the liability is repayable on 31st March 2015 and 2019 at par. Vale PLC treats financial liability in the short term. The fair value of the financial liability were $24 million and $24.8 million as at 31st March 2016 and 2017, respectively. Required. Show the financial statement extract for the period to 31st March 2017. Sandra,
Okay. We have question 10. Bill PLC. We issue the financial liability and they trade financial liability in short term. Since they are trading it, it means we'll be accounting for it using fair value through statement of profit or loss. And when we are accounting for it using fair value through statement of profit or loss, what do? We'll be charging what? We'll be calculating the fair value difference every year.
ṣé fóònù yìí ti súnmọ́ bí báyìí láti wà kọ́ lọ́dọ̀ rẹ̀.
Sọ́tọ̀ àlẹ́.
Ìlú ìwọ̀ mo fẹ́ lọ stew. Are you sure?
Okay. We'll have carrying amount which is how much the nominal value, because they would have recorded the liability at the nominal value initially. That's what 25 million. So that means we have what? A fair value what? Is it a gain or a loss?
Fair value loss. It's a
A
loss,
loss.
sir. Loss of 1 million.
Okay, can you guys hear me? I'm so sorry, I don't know why the network is going off and on. Hello, can you hear me?
So,
We can hear
Lano is
you.
Hello?
Yeah, we
So
see
that
the fire.
explains why. Huh? What is it?
I say we can hear you.
Okay, so that explains why the fair value difference is the fair value gain. Did you hear my explanation on how we got it to be fair value gain? Huh?
We didn't get your question, sir.
Did you hear my explanation on how we concluded that this one difference here is fair value gain?
Maybe she will explain again, sir. Sorry.
So we have what? The carrying amount of the liability is 25 million. But at the end of the year, the fair value is 24 million, which shows that the liability has increased by 1 million. The liability reduced, but we haven't made any settlement. It's only reduced by way of fair value. That means it's a gain to us because we now have less to pay to settle our liability. Do you understand? It's just like saying, I'm owing someone 500. There may be because of one thing that happened between the two of us. The person now say, okay, don't worry, pay me 400. The 100 naira difference between the amount I'm owing and the amount I have to pay back now will be a gain to me because I don't need to pay that person back. And if you look at the double entry, in the liability account, we initially have 25 million. But at the end of the year, to recognize it as fair value, we want it to be 24 million. That means we have to debit the liability with 1 million. That's how the closing balance should be 24 million. The corresponding credit entry for that debit of 1 million will be in our SOPL. And a credit in SOPL shows it's an income. Is that not it? We understand?
Yes, sir.
Yes, sir. So if it was a financial asset, it would be a loss.
Sure. Because in that case now, the financial asset is losing value. Do you understand?
Yes, sir.
At the end of 2017, the fair value is 24.8 million. And the carrying amount, which will be the fair value of the previous year, will be how much?
24 million.
24 million. So that means we have 0.8 million what? Loss.
Gain.
Loss.
There's
Because
a
now
lot. Oh,
it's a loss because our liability is increasing.
okay.
Do you understand?
That's true. That's
Huh?
it's true, sir.
Mi gbọ́ Yorùbá, ẹ bá mi ṣe tí mo gbọ́.
He said it's true.
Okay.
But you didn't put
Then
the 0.8 on that letter.
I did not put it in bracket. Sorry about
It
that.
is a lot.
Pardon me. Ẹ má nà mí ẹ jọ̀ọ́. Ẹ má bínú. SOPL extract will be what? 2016 and 2017. Income. Fair value gain. That was in 2016. 1. Then
1 million.
expenses. Fair value loss. 0.8. Wakati, in our statement of financial position extract, we'll have what? Because the liability is held for trading, it will be taken as a current liability. Financial liability in 2016 will be what? 24 million. In 2017, it will be 24.8 million. Does it make sense?
Yes, sir.
So that is that. So let's look at a compound instrument in illustration. Question 11. Who is reading? Who is reading? Hello.
Good morning, boss. Violence, PIE, issued a 10 million 4% convertible loan note at par on 1st October 2002, with interest payable annually in arrears. 4 years later, on 30th September 2016, the loan note is convertible into equity share on the basis of $50 to loan note of 20 equity share, or it may be redeemed at par in cash at the option of the loan note holder. One of the company financial assistants observed that the use of the convertible loan note was preferable to a non-convertible loan note, as the latter would have required an interest rate of 8% in order to make it attractive to investors. The assistant also commended that the use of the convertible loan note will improve the profit as a result of lower interest cost, and as it's likely that the loan note will improve the profit as a result of lower interest cost, and it is likely that the loan note holder will choose to equity option. The loan note can be classified as equity, which will improve the company high gearing position. The present value of $1 receivable at the end of the year, based on discount rate of 4% and 8%, can be taken as year one to all figures correct. Require comment on the financial assistant observation and show the convertible loan note for the Violin plc financial statement for the year ended.
Okay. Thank you very much for that. As we can see from what we have here, we have Violence PLC that issued a convertible loan note. And because the loan note is convertible, they will be paying interest at 4%, even though such loan would have required an interest rate of 8%. Now, that is a compound instrument because it has created an equity as well as a financial liability. Even though the equity only materialize when they go for the option of conversion. But we have to first split the value of the transaction into what is the equity portion and what is the liability portion.
I thought you said
so we'll have Violence PLC. That's what I love the most. Question 11. Violence. So
what do you love the most, sir? Is it the fact that it's a violent PLC?
Huh?
Is it the fact that it's a violence PLC that makes you love it?
Anything that has violence in it.
He likes violence.
So we have one computation or calculation. Calculation is more appropriate. Calculation of present value of the financial liability in that transaction. So to calculate the present value of the financial liability, we'll have the year, we'll have the cash flow, we'll have the discount factor, which will be at the effective interest rate of 8%. Then the present value, which will be the multiplication of cash flow and the discount factor. So year one, which is 2003, is it 2003? They are not constant with the year. In some place they use 2003, in another place they are using 2016. Should actually be, is actually either of the two. So year one, what the cash flow from the transaction in year one would be the interest, and the interest will be what? 4% of that 10 million, and that will be what? 0.4 million. Year two, the same thing, 0.4 million. Year three, 0.4 million. Year four, it will now be what? The principal repayment of 10 million and the interest payment of 4 million. That makes it 10.4 million. Then the discount factor, they've given us that one. We'll just take that of 8%, 0.93, 0.86, 0.79, and 0.74. Figure.
Yes.
Figure.
First one is 0.372.
0.37.
2. 372.
Let's not exceed 3 decimal place, please.
Okay.
The one is 0.316.
316.
Third one. Yes, sir.
The next one is 0.316.
Next one or last one, which one are you talking about?
No, sorry about that.
Second one.
The last one will be
Second one is 0.356.
Oh yeah, the second one, who is giving us?
0.356. Sorry, I made a mistake.
0.344.
344, 356. Oh yeah, let's fight it out.
344.
So
the last
summation
one,
of each
sir.
one is how much?
7.3.
Last one, 7 point what?
696.
So you do. Can you not see it there?
6969. It's correct.
Okay. 8.728. So we'll say calculation of equity component of the transaction. So the equity component of the transaction will be what? Nominal value is what? 10 million, Abi? So
Yes.
because we are using 3DP, let's take it to 1,000. That will be 10,000 less present value of financial liability. Present value of financial liability will be what?
8,000.
8725.
No,
So with
7.
this equity portion, 728K.
Yes.
Bàbá,
It's
ó pẹ́ dé party yìí o. Láti nǹkan tó ti fún mi wrong figure tó sọ̀rọ̀.
728, sir. Sorry.
So what do we have? Difference will be what?
1272.
One what?
1272.
1272.
1272.
So if that is the case, we can then go ahead. Since the bond is not held for trading, it is not designated to be fair value through statement of profit or loss, we go ahead to what? We go ahead to use amortization method to account for it. So we'll show our amortization schedule. Amortization schedule will have here opening balance, interest at what? Effective interest rate of 8%, the payment at nominal interest rate of 4%, then closing balance. So what do we have? Year one. Year one will have what? Opening balance of 8728. Interest at 8% is what? No decimal, please.
$698.
698. The payment would have been what? 400,000, Abi. So what will be the closing balance?
Why we say 400,000?
That's 4% of
Me, bro.
10,000.
Oh, thank you, sir.
9026.
9026. So year two, 9026. Interest at 8%.
$722.
Closing balance, year three.
$9348.
Interest at 8%.
$748.
400. What do we have as the closing balance? 9696. Okay.
9696.
Nine, 6, 4, 6, Abby.
696.
9696. Year 4 will have 9696. Interest will be what? The closing balance will be what? Then what? This is 10,072. The excess of 72 will be approximation difference. Approximation difference. So we can actually adjust for it in the last year interest, because what they will be paying will be 10 million if those people don't if they don't convert to ordinary shares. So that is that on that. So if that is the case, we can then show our statement of profit or loss extract. And in our statement of profit or loss extract, we will have what? Year 1, 2, 3, and 4. Expenses. Finance cost. 698, 722, 748, and 776. Then in our statement of financial position extract, one, two, three, four. We have equity. Other components of equity that will account for the equity component of the liability. And the equity component of the liability is what? 1272. 1272, that will remain the same all through until they either convert or they don't convert, when we will now take it to our retained earnings. Then, under our non-current liability, we will have financial liability. Then, current liability, we will also have what? Financial liability. One, it is 9026 9348. Yes, 39696. Yes, 10,000. Please adjust this nigger, this bagger. Adjust it. That will be 704. Because we cannot pay them more than the 10,000. Okay, ladies and gentlemen, boys and gentle girls, I hope with these few points of mine, I've been able to confuse you on what IFRS what? On what financial instrument accounting is all about, right?
IFRS 9.
One.
Is it that you confused us or convinced us?
Not paying anything. No, that one we'll be making payments here. So part of the principal will pay. The principal portion of the pay will take to the current. And with you, what do you say?
Is it that you confused us or you convinced us? Which one?
It's left to you. You know, everybody goal and aim for the class is different. Mine is to confuse you. You now feel convinced, good for you. You feel confused, good for you. But any which way, I hope when we see questions on financial instruments now, we'll not run away and say it's too hard for us.
We'll try.
Another scenario I think we might not be used to is if they now give us the present value or the future value or the fair value of the transaction, and he gave us the redemption value. They now ask us to calculate the effective interest rate. Effective interest rate in that case will just be the fair value divided the redemption value divided by the fair value or the present value. That will help us get what our effective interest rate should be, because it would have the effective interest rate is what would have made the value go to the redemption value at the end of the year. But any which way, ladies and gentlemen.
Hello, sir. Come again with that. This thing. Redemption value over what?
Impossible. According to the Bible, it has been written for man to die once. After that,
just redemption over what? That will be all. I won't ask again.
Redemption value divided by the fair value or the present value, depending on if it's asset or liability.
Okay.
So that is that. We can also try and look at things that are on financial instruments, especially for SBI. You cannot escape it. Any issue, you meet it at the front. For FR, you cannot escape it. All your bad behavior, you meet it at the front. Ladies and gentlemen, thank you very much. See you guys in the next